Hello guys. Welcome to our second tutorial from EGF Academy. In this tutorial, I'm going to explain the basic principles in Forex trading. Okay, basic principle in Forex trading. Number one, a pip. Number two, currency pairs. Number three, lot sizes. Number four, spread. Number five, a leverage. Let's start with a pip. What is a pip? A pip is a small measure of change in a currency pair in the forex market. A pip is usually the last decimal place of a price code. As you can see, those are representing pip. So I'm going to explain lately. Most pair goes out to 4 decimal places like this one, but there are some exemptions like Japanese yen pair. They go out to 2 decimal places, as you can see. How to determine or calculate a pips? In this example, we are going to use this one, a dollar. The last number represent a pip. If it's a 1, it means it's a 1 pip. If it's a 2, it's a 2 pip up to 9 pips. Then if it becomes 10, we jump to the second number. This one represents 6 pips. This one, it represents 90 pips. It represents 90 pips excluding the 6, but in this case you can call it 96. And the third one represents 300 pips. If we assume the last two numbers are zeros, but you can, in this case, there are 396 pips. The fourth one represents 8,000 pips, and the last one represents 20,000 pips. As you can see, guys, it's just a straightforward math. Then the currency pair. What is a currency pair? A currency pair is the quotation of two different currencies with the value of one currency being quoted against each other, like USD against ZAR. This is called a currency pair. Okay, the first listed currency of a currency pair, it is called a base pair. In this case, USD is a base pair, the base currency. Then the second currency is called code currency, like a rand. ZAR, it's a code currency. Currency pair. A currency pair compare the value of one currency to another. The base currency of the first one versus the second one of the code currency. It indicates how much of the code currency is needed to purchase 1 unit of the base currency. Lot sizes. This one, they are very important, guys. A lot are basically the number of currency units you will buy or sell. The standard size for a lot is 100,000 units of currency, guys. But we have different sizes. Now there are also mini, micro, and nano lot sizes. A mini lot size is 10,000, guys. Micro is 1,000, and nano is 100,000 units, guys. Spread. What is a spread? A spread Add the numbers of pips separating the bid and ask for a currency pair. They can range from 2 pips up to plus 100 depending on the currency pairs. A spread is simply defined as the price difference between where a trader may buy or sell an underlying asset. Spread from a chart. As you can see, our top line normally it it is it's red represent ask. Then the bottom one it is called a bid. It's spread. It's the difference between those two. You take the ask minus the bid, you get the spread. Here it's gonna be clear, guys. As you can see, our bid is 101.15 and ask is 101.20. You can say ask minus a bid. You get an amount of 5. So meaning our spread is 5. A leverage. A leverage in Forex is the ratio of the trader's fund to the size of the broker's credit. In other words, leverage is a borrowed capital to increase the potential returns. Forex leverage size usually exceed the invested capital for several times. The end. Thanks for watching, guys.